Hello, welcome to Be the Boss of Your Money. We are just getting ready to get started. We finally have ourselves a real down market on our hands. Real down market. That's right. Finally have a down market. There are a number of reasons behind it. Not all good. Not much of it anyway. So let's take a look what's happening because stocks, as you know, if you've been a viewer of this live stream, we've been talking about poor market breadth, stock market deterioration for ages now. And it looks like it's finally catching up to the rest of the averages. We're going to figure this out. We're going to talk about why. We're going to talk about energy plunging today. The 10-year yield, the interest rate, completely plunges again below 1.2%. It is just screaming recession right now. Got a couple of things to talk about. Not all is lost, though. Not all is bad. We have to see what we're going to do. A little bit of an action plan. Because most of us are not just going to walk away from the market. We're investing for the long term. So a lot of this isn't really so meaningful. What is meaningful is what you do, or better yet, what you don't do. So don't make any hasty decisions. We're going to talk about that right now. Let's roll the intro, and then we're going to get into a really good show. As always, I love hearing from you. I'd love to answer your questions in the comments. Words of wisdom, words of encouragement are always appreciated. You're watching my live stream, Be the Boss of Your Money. I'm Mitch Goldberg. Here we go. Ugly day in Wall Street today. Today is the worst single day for the stock market since 2021 began. There are a number of things that pull the market down. Basically, the large cap mega stocks that move the averages around, you know what I'm talking about, the same ones you talk about all the time, Facebook, Amazon, Apple, right? Google, which is really Alphabet, the same ones we talk about here all the time, okay? They finally, Microsoft, they gave back the ghost. They gave it up today, and they finally went down in addition to so many other stocks that are down. There's a term called poor breadth. I don't mean breath like bad breath. I'm talking BREADTH. And that's a situation when you have more stocks going down. That's a situation when you have more stocks going down than going up. It's a situation where there's real deterioration, but you just didn't notice it because the S&P 500 just a week and a half ago was hitting new highs. And if you think about it, as scary as the headlines are today, the actual S&P 500 index at this moment is only off about 3.5% from its all-time high. So what's with the fear? Remember, I've been saying this is the rally that investors love to hate. I've never seen a market that's been hitting new highs that is hated by so many investors. And anyone you talk to is going to say, how is the market doing so well when it looks like so many stocks are not doing so well? So here's the thing. If you're just an index, and by the way, the S&P 500, we know it's an index. I have to tell you, you can't invest directly into an index. You could invest in a security that tracks or mimics an index, but not the actual index itself. There's a distinction, and I need to make that distinction very clear. So how can markets go up? People hate this rally because bank stocks have been getting crushed. Industrials have been getting crushed. Materials, energy, crushed, and more crush. This is like just the crush market. But what's not been getting crushed are consumer staples, food, right? The kind of things that work well when the economy is ready to slow down. So what's the deal? Let me put it all together for you. We have this reopening, right? It started, the excitement, the enthusiasm for the reopening trade started around October of last year, October, November of last year. We got real evidence of reopening as cases started to go down, COVID cases started to go down, business started opening up, people started flying more. It really accelerated when the vaccines were giving out en masse. But around April or so, a lot of stocks started turning over. The Russell 2000 small cap index, we talk about that index. The Russell 2000 index, it's, by the way, while you're watching this, let me know how I'm coming out to you, okay? All right, so just a quick note. Hi, Daddy, from Jess. Brian and Zach are watching with me. Love you. I love you too, sweetie. That's so sweet. Thank you, Jess. I'm glad. That's my daughter. I'm glad you're watching with your friends. I hope the show lives up to your expectations, guys. So the Russell 2000 is an index. It's the primary, most followed index we have that tracks small cap stocks. Small cap stocks are more sensitive to the domestic economy. They are less likely to get a lot of their revenues from overseas. And when they're not doing well, when that index is not doing well, small cap stock index, the Russell 2000, it's usually a sign that investors are losing confidence in the strength of the economy. So aren't we supposed to be in this grand reopening where everything is so strong and that's why we have inflation? The answer is yes. And that growth expectation, and we have been seeing growth. It's not just expectations, it's growth. We're seeing that. But the fly in the ointment is rising COVID cases. This new COVID variant, okay, the Delta strain of COVID. It's starting to spread like crazy in the United States. And it's, COVID cases are rising, I think, in almost all 50 states now. Some areas, a lot, obviously, areas with lower vaccination rates are seeing a higher rise in cases, hospitalizations, and unfortunately, death count. So it's a really sad state of affairs. We've talked about the economy here. Does this throw us back into an economic shutdown? Do we have to stop going to restaurants again? Do we have to have limited seating? I mean, I don't know how much more restaurant owners could take. What about cars? I was actually in a car dealership today. I had to get an oil change for my car. And the manager of the dealership, Acura, if you want to know, he said, we have 50 cars in the lot. I said, 50 cars sounds like a lot. He said, we usually have 300 plus. Can't get any cars. So there's just so many funky things going on. We had a lot of supply disruptions because of the economic shutdowns. So we're going to have more supply shortages. We're going to travel less. You see what's happening with the Olympics. A number of Olympiads in Olympic Village have been diagnosed with COVID. They've been COVID positive. We're seeing cases spread. The CDC today advised against traveling to the United Kingdom. Maybe we'll see more advisories like that. I did hear that correct me if I'm wrong, the CDC, I don't know if they're considering this or if they're just going to do this, but I'm hearing wearing masks when kids return to school at the end of August or early September, depending on where you live. I don't know. Does the public have a stomach for that, for mask wearing again? We're just starting to have fun. We're just getting out again. We're just going out to dinner again, my wife and I. I don't want to go through this again. Look, we do what we have to do, whether if we like it or not. So that's the real crux of what's going on, is the COVID plus inflation plus the yield plunging on the 10-year Treasury bond, energy plunging. There are some technical reasons. Look, we've been talking about energy, by the way, on the show, and I've been saying, even though you see the price of oil going up and up and up all the time, it's going up. You see the price of gas going up. And I said to you, the reason energy stocks aren't participating, usually if oil goes up, energy stocks should even go up more, but energy stocks have been dead money. Why? Because investors know that all OPEC has to do is come out and say, we've agreed to increase output. We have a deal. We're going to flood the market and oil is going to come right back down again, which is what happened today. Exactly what happened today. There are some things I don't want to be right about. There are some things I will be right about. Okay. I know there are some things I'm going to be wrong about plenty. Of course, I'm not trying to come off, full of conceitment here. Okay. So got a couple of notes that I take. I want to just make sure I show you a couple of things. Okay. COVID cases, 30,000 new cases a day versus 11,000 daily cases a month ago. Global economy. You see, we don't have COVID vaccination rates in most of the world like we do in the U.S. Hopefully in the U.S. they keep improving. But this could create a whole new shutdown in manufacturing and mining economies the world over. So it's another thing to worry about. More stimulus. Well, I think we're past peak stimulus. I mean, we'll get an infrastructure bill, it looks like. And we've got the child tax credits that just started going out last week. But what more do you expect? Maybe, the Fed's been talking about pulling back on its bond buying program and maybe raising interest rates a year earlier than we originally expected. Now, is what's going on with COVID and the economy, how COVID could affect the economy, is that going to get the Fed to keep its bond buying program in place? These are all questions that remain unanswered. They're creating tremendous uncertainty. I don't have the answers to these. I mean, I know people are saying, I think they'll do this. I think they won't do that. I think COVID cases will be contained. I think the economy does great no matter what happens with COVID. So I'm going to tell you what Mitch Goldberg thought here. If you're a long-term investor, keep being a long-term investor because you will get through this to the other side of all these problems. We'll have a whole new set of problems, but we'll get through these problems because that's the way markets work. Okay. If we have, if you're talking about money that you might need in the next year or two, we talk about this all the time. That's not an investment question. That's a personal finance question. And you should always let personal finance be your guide to buying and selling because odds are you're not going to just say, you're not going to time the market and say, I'm going to sell everything at the peak and I'll have all this money. And when the market tanks, I'm going to buy everything back at the low. And then I'm going to parlay all of this money into even more money. And I'm going to be rich, rich, rich. No, it's not the way it works. That's the dream that a lot of people try to sell you on, like Robinhood and other online trading apps. But that's not what's going to happen for you. Okay. So I just want to let you know that. Let's take a comment from my good friend, Josh Barron. Josh says, COVID numbers are up among the non-vaccinated. Fully vaccinated may contract COVID, but will have light symptoms and will not need to be hospitalized or die. So count me in for a dinner date. Oh, that was good. Yeah, you're in, man. You're in. The next networking event, I'm gonna get you your dinner because networking events usually come with some kind of dinner. But I'll fix you a plate. You sit down. I'll go get you a plate. I'll get you a plate that my own mother would be proud of, which would be like a plate from a buffet stacked like this high. I'm sure you know what I mean. Your mother probably the same thing. So and Jess loves the show. Thank you, sweetie. It's my daughter. And I'm very proud of you. So these are the things that are taking place within the four walls of the stock market. We're trying to figure them out. They will be answered. A lot of these things will be figured out, but I don't think they're going to be figured out by the end of this year. And I know you might be thinking that's a long time, but seriously, we're almost through July already. And that once August starts, the rest, we're going to be in the fall like that. in like 2.5 months, maybe sooner, we're going to start seeing Christmas decorations go up at the retailers. It makes sense from a retailer perspective because it's expected that we're going to have a really good retail season because of all the money going out from the child tax credit money, okay, which affects like 90% plus of all households, okay, that have children. So a couple of things. These are the major issues. I'm going to show you a couple of things on my screen. So now we're going to do the share screen, okay? Pop myself right over here. All right, here I am. Hi, up here in the corner. All right, so let's take a look at this one first. Who are those ugly guys? No, I'm not kidding. Let's blow up the screen so you could really see it. Let's go to U.S. markets. Dow down 725 points, down 2%. You know, when the market's down, any of the averages are down 1% or more, it does get my attention. I saw someone before earlier today say, "Oh, you must be having a crazy day with the market," because I was coming into my building from another appointment this morning. And I'm like, I don't change my day based on how the market does. The market's up or down a lot. Really doesn't change my day. I'll tell you a little story. Just want to tell you. About 6 years ago, I visited a client in Florida. The Dow that morning was down about 1,600 points. Procter and Gamble. Actually, no, it wasn't Procter. The market had tanked. It turned out it was a flash crash. And the client said to me, "I could understand if you didn't have time to see me today. You've got a lot going on." And I said, "You know what? Doesn't make a difference. The market's going to do what the market's going to do. But seeing you is something we can control and making sure that we're on track with your investments, your plans, etc. That's what counted. By the end of the day, the market recovered anyway. So I don't change my day's activities based on how well or not the market did. By the way, you notice I'm wearing a tie today. I was on News 12, so the loop will start in a little while. I was on with Rich Barabi, one of the anchors in News 12, to talk about today's stock market, why it went down, what happened, and we'll see how it goes. He always asks me good questions. Happy to answer them, and we'll see. You know, you get like 8 minutes of time, and then they edit you down to about 10 seconds. But it's an important 10 seconds, so that's cool. I'm very lucky to get those calls. NASDAQ down 1%, down 150 points. S&P was down 68 points. Things were worse. I mean, the S&P was off over 2% at one point today. Oil, though, down 7%. That is a big day. Oil was up to about 75, 76 a barrel. So oil is in more than in correction territory. The 10-year Treasury was 1.75, 1.78 a couple months ago, back down to 1.19%. That is screaming recession right there. And the VIX, remember what I always said? VIX, right? Under 20, we're okay. It goes over 20, markets tank. It's happening. Russell 2000 down 1.5%. Commodities complex mostly down. Interest rates down. Let's go on to another screen. Okay. Let's go to the watch list. Okay. Consumer staples. Hain, B&G Foods, ConAgra, General Mills, Costco, Kellogg's, Clorox, Beyond Meats, Kimberly-Clark, Church & Dwight, Kraft Heinz. Pepsi was off 2 cents. Big deal. You know, that's just because the market was down. But stocks that typically go up in bad times did well today. These are just a lot of bad signals. And if you look at these stocks, if you look like this line for ConAgra, the red and the green, that's the year high, the year low. A lot of these stocks, with the exception of Costco, have already corrected. So a lot of these stocks are cheap now. They pay decent dividend yields. That's how they're perceived by investors. So investors might say, you know, if we're going to get into an economic slowdown because of COVID and inflation could slow things down, maybe we need to be in these kinds of stocks. And that's what investors are doing. And they're already cheap. They're off their year highs, right? Way off. Let's go on to the disaster that's called financials. Let's go to the worst ones. Forget MasterCard. It's really more, you know, plastic, fintech, that sort of thing. But USB, US Bancorp, down 4%. Key, American Express, AIG, IAT, that's the ETF for regional banks. Travelers, JP Morgan. JP Morgan was just 167. It's 146. Stock's getting pounded. Let's go on and take a look at the FANG. The FANG stocks. The N is for NVIDIA. NVIDIA had a really good day today, but that stock has been pounded in the last few weeks. But that did help things with the NASDAQ and the S&P. But Apple down over 2%, Amazon down, Facebook over 1% down, Google down over 1%, Microsoft down over 1%. S&P 500 is not going to hold up when most of these giants are down like this. It just adds fuel to the fire. But these are the stocks that are holding the market up while most stocks are going down. You see, if these stocks go up and most stocks go down, you're not going to know if you're just investing in the index. You're going to find out today, though, that everything's, that they're going down because these stocks are like, they have such a strong gravitational pull. They dominate the S&P 500 because of their size. So if they all go down, they pull everything down with them. Okay, let's take a look at the reopening stocks. Carnival was up to 31. Oh my goodness, down under 20. You see that variance? The year high, which is recent, down to down to 19. Look how much of the red is in these lines. These stocks have come down so much. UAL, Norwegian Cruise, Planet Fitness. Oof. I mean, these are all the stocks, that should be doing well right now in a reopening. It just goes to show you that Wall Street is freaking a little bit about the strength of the growth story. These stocks aren't down a little. These stocks are down a lot. I mean, Southwest Airlines, it's just up to $64 and change, down to 48. And at this point, I can't even say they're cheap because if COVID keeps spreading, we start having more lockdowns and start saying you can't fly here, you can't fly there. Here we go again. These companies literally crawled out of the pandemic shutdown. You think they could take another shutdown? Does the government want to give us another payroll protection program? How much more stimulus can we get? I'm giving you the negatives. There are not all negatives. We'll go over some positives in a couple minutes. Okay, let's take a look at the Corona list. The Corona list. Where the F is? Let's take a look at the meme stocks. So I have here. Meme stocks did okay, but these things have gotten crushed already. Look, AMC was up to 72. Now it's 34. Yeah, Clover is up 10 cents, but it was up to 28, down to 8. And it was recently up to 28. That was like, 2 months ago? We're going to take a look. Stay with me, guys. Come on. Ask questions if you have any questions. Words of wisdom are always appreciated. Here's the Corona list. I named my Corona list the Corona list. Zoom is off 2%. Stock is up a hell of a lot, though, in the last couple of months. I know, down from $588. Like I said a long time ago, Zoom is in trouble. I don't think you're going to see those prices again. But Zoom also, they made an acquisition today, so that knocked it down a little bit. ATV is off, Activision Blizzard. I think one of the reasons it's off is because was it one of the other online purveyors of entertainment said they want to get into the gaming sector. I wonder if that's competition. That's why it's down. I think so. But Clorox is up, Campbell's, DocuSign, Teladoc, DoorDash, Peloton. Oh, Peloton's up. It should be up because if we're going to another shutdown, people are going to keep buying Peloton equipment and keep working out at home. We've realized how important being in shape is, especially when you're home during the pandemic. While you're watching this, if you would, give me a thumbs up, a heart. Show me you're there. Show me you care. You're on. I am on. I am en fuego. That comment was from like 9 minutes ago, but I appreciate it. Thank you very much. Andrew's out there. VIX is what I checked, like you always say. Sorry I missed the beginning. Yeah, it's okay, man. You're here now. You're safe. You're healthy. And you're here. That's all that counts. That's all. Nothing else. Yeah, the VIX, man. The VIX is just finally skyrocketed well above 20. So that's another thing to keep an eye on. Last thing we'll take a look at is how all the sectors did. These are the ETFs that track the sectors of the market. If you want to know my most important dashboard, you check this. All right. Thank you. Eric is out there. Eric Hagan. Thank you very much, my man. I appreciate it. Love seeing the pictures of you guys in the Badlands. Was that in South Dakota? Those amazing pictures. And Andrew, thank you very much. Dr. Phil. Dr. Phil is in the house. Double thumbs up. Thank you so much, Phil. I really appreciate it. Oh, you're so good. Got a couple of snippets coming out over the next day or two. Keep an eye out for those if you would. Something we've been talking about. Okay. Jess says hi from Zach and Brian. Good to see you guys. Thank you very much. And Phil, thank you again. All right. So the best performing sector of the day was staples, which was still down a little bit. But again, staples, then healthcare. You don't want to see staples and healthcare lead the market. You want to see them lag the market, because when they lead the market, you take that as a concern that investors are not confident in the economy. Okay. Tech was down. Everything was down. Utilities. I'm surprised utilities didn't do better with interest rates down so much, because utilities pay dividends and yields go lower. It would make the dividends of utility stocks a little bit more attractive, on a relative basis. And what else do we have? Energy at the bottom of the heap. Okay, we could stop sharing that screen. So this is more or less the summary of what's going on. It's stuff that we've been talking about on the show for a while, but what's the action plan? I hate to sound boring, but the action plan doesn't change. For different clients, you have different kinds of accounts: a conservative account, a moderate risk, then risk, growth risk, right? Accounts. And you have to start making sure that your assets that you're going to need are in cash or in something more stable than stocks, something a lot more stable. And these are the things that we do. Should you be a buyer in this market? Like if you said to me, hey, I've been sitting on some extra money, I think I've been thinking about putting it into the market. I can't tell you if today is the exact day to buy or not. And if I say every day, today is the day, the ultimate best day to buy, and I said that every day in my 31 years of doing this, I think I would have been right maybe 3 times out of 31 years, because how many times do we get real true bottoms? We had one in March of 2020. We had one in March of 2009. We had one in early 2003. I don't know if it was March of 2003, but these were real bottoms when it was really a good time to buy. Do we get through this? Absolutely. We are going to get through this. Is it lights out for the whole market? I don't think so. I think we've had a number of readjustments, a number of growth scares, a number of taking speculative froth over. So I'll leave with this thought, because I feel like I want to cut this off at 30 minutes. We're almost there. One of the things we've been talking about is crypto, meme stocks, SPACs, and small caps. These are the aggressive to highly speculative parts of the stock market. And when these go up a lot, the way they have, speculative froth to me all the way. That's why I didn't get you involved with these things. Okay. They're fun while they last, but it's a sugar high. It wears off, and then you feel like crap when it's over. But when the more investments, the more assets that participate, in a rally, the healthier the rally is, the more energy it has, the more buying power from investors it has. And when these spaces start to shrink, go down, again, SPACs, crypto, meme stocks, and then small caps. And again, the small cap stock index, the Russell 2000, again, an index is not something we can invest directly into, but you could invest in a security that tracks your membership index. The Russell 2000 is down about 10% from its March high. March is a while ago. So yeah, that's how long a lot of stocks have been deteriorating, while many don't notice, because the S&P 500 index has been going up because of a handful of mega cap tech stocks that bring it up with it. But when these aggressive parts of the market start to deteriorate, my interpretation, energy is coming out of the market. Investors migrate into the larger cap stocks, the large cap tech stocks, where they feel safer. And so those run out of buying power for whatever reason. It could be a spark, such as rising COVID cases, higher inflation, We're just that investors have gotten their full fill of these very highly maybe over-owned stocks, and then they start to go down. Not a good sign to see the speculative froth come out of the market because the market's running out of energy. So it's not a good sign. But it's a good thing that the speculative froth is coming out. So when the market rallies back up, it'll be on strength, on solidity, on companies that we could own. But I think right now we could just wait for the companies that we want to own for lower prices. Thank you for watching. I will be back tomorrow. And just a little bit of housekeeping. I have a guest, my friend Filippo Impinato. Impinato is going to be my guest on Wednesday, and we're going to talk about crypto. And I'm going to ask him point blank, I just don't see it. So why should I be a believer in crypto? And hopefully he could get me around this. All right. I'll speak to you soon. Speak to you tomorrow. Thank you so much for joining me.